Good morning, traders, and a Merry Christmas to you all. Your present this year is the one chart you need to simplify your trading. It is ultimately going to be SPX versus gold. SPX represents risk on, gold represents risk off. I've got three different charts shown here. The blue and white bars being M2 versus SPX, the yellow line being M2 versus gold, and as I said, the only chart you need, SPX versus gold. Now the whole purpose of this is to show you when you should be fleeing to safety, into gold in this instance, versus when you should be trying to multiply your gains via SPX equities. Risk on, risk off. And looking at this chart, we can see there's a nice inverse relationship. Okay, when stocks are bottoming versus M2, gold is generally peaking. When gold is bottoming versus M2, stocks are generally peaking. So this is a beautiful way to show you which game you want to be playing. Am I trying to preserve the capital I've gained, in which case I'll be fleeing to the safety of gold, or am I trying to multiply my gains and level up, in which case I'll be risk on and going to SPX equities, whatever your particular flavor is. Now for a much cleaner look, going to SPX following these rules, we would see that we would have sold out of equities back in the late 60s, early 70s, and we would have been in gold. We wouldn't have started entertaining the idea of getting back into equities until basically the late 70s, early 80s. Okay? Now, if you look at what happened by doing so, that safety didn't just preserve your wealth, it magnified it immensely. You would have sold out of your equities here and you would have bought gold, and you would have been buying gold at 40 bucks an ounce. Now I get it, yes. Wasn't, you know, legal to own gold for a long time in this country, but for all intents and purposes, gold has always been the go-to for safety. There's a reason governments are continuing to purchase it. BRICS nations are purchasing more and more of it as of late, etc. But had you gone to safety of gold, you would have rode it up all the way from 40, 50 bucks an ounce. And you started getting your signal that, hey, maybe we should take some more risk in the markets. Let's sell out of our gold and move to equities. So you bought your gold at 50 bucks an ounce and you ended up selling out of it, whatever, 600 an ounce if you got out late, 500, whatever. You made a 10x on your money right there. And that 10x you made on your money was in a period when equities did nothing. The S&P was at 100. It was still at 100 that decade later. Sideways action, you avoided it. So you sell out of your gold at 500 to 700 bucks an ounce, get into equities, and what happens to equities? They go from 100 to 1500 before you get your signal that, hey, we need to get back into the safety of gold. Okay? And what happens? You go to the safety of gold and we chop along yet again a decade of boring nothingness. Okay? You would have avoided all this. And not only would you have avoided all that, but during that decade, what did gold do? Well, you sold out of it in the 500 to 700 range. You're buying it back in the 2 to 350 range, let's say, and you ride it up again for a 5x. So yeah, you're not getting the multiples on gold that you get in equities, but equities weren't doing that during the period when you decided to go to the safety of gold. So you're times 5 in it, times 15 in it, times 5 in it. Okay? It takes us back to our current chart. We're kind of in an in-between period here. Now, if anything, this chart is saying that we're closer to a bottom in gold and closer to a top in equities than the inverse of that. So am I saying sell all your equities and buy gold? No, I'm not making any type of shot call like that. But what I am saying is pay attention to SPX gold. It's really the one chart you should be looking at in order to decide, am I in a period of wild, wild west trying to 15 exit in equities? Or should I be looking at the safety of gold? And maybe you take some kind of range here and you slice it into ratios, whatever. Pull your fib, do whatever the heck you want, and just say, at this point, I'm 50-50 in each. Once we start getting up into here, maybe I want to, you know, be 50% into gold or, two-thirds into gold and a third of equities. And when you start getting up even higher, like, no, I need to be primarily gold and selling my equities and vice versa. You see the ratio down here? You should really be loading up on your equities and not worrying about holding your gold too much. Anyways, Merry Christmas to all once again, and thank you for your 6.5 minutes.